Hey everyone, let's talk about a stock that's getting a lot of attention lately, but not necessarily for the right reasons, BigBear.ai. Now, on the surface, this company should be in a perfect position to win. We're living in a time where artificial intelligence is becoming one of the most important technologies in the world, especially in defense. Governments are investing billions, global tensions are rising, and AI is quickly becoming a critical tool for national security. So logically, a company like BigBear.ai should be thriving. But when you actually dig into the numbers, the story looks very different, and honestly, a bit concerning. Let's start with the headline. BigBear.ai is currently being viewed as a sell, and there are some strong reasons behind that. First, the company is dealing with declining revenue. Second, its cash burn is increasing significantly. And third, when you look at the valuation, it simply doesn't match the performance. So even though the industry trend is positive, the company itself is struggling to keep up. Now here's something interesting. About a year ago, there was a bullish case for this stock. At that time, things looked promising. There were moments where the stock actually performed well. But fast forward to today, and the stock is sitting roughly 10% lower than where it was back then. So something clearly hasn't gone according to plan. Now let's talk about the bigger picture because this is where things get a bit confusing. The environment for BigBear.ai is actually very favorable. Defense budgets are expected to stay strong. Governments are prioritizing AI more than ever. Even recent tensions between major players in the AI space, including disputes involving companies like Anthropic, show just how important this technology has become. The US government in particular is pushing forward aggressively with its AI strategy, and BigBear.ai claims this plays directly into their strengths. They position themselves as a company that understands real-world defense operations, not just theory. They focus on building AI solutions that are secure, fast, and adaptable, exactly what military and national security clients need. So again, on paper, everything looks aligned for success. But here's the problem: execution. Because when we shift from the narrative to the actual results, things start to fall apart. Let's look at the latest numbers. In the fourth quarter, BigBear.ai reported revenue of just $27.3 million. That's not just a small drop, that's a massive 38% decline year over year. In fact, this is one of the worst revenue performances the company has seen in the last 3 years. And it gets worse. They also missed expectations by over $6 million. That's a big gap, especially for a company that's supposed to be in a high-growth sector. So what's causing this drop? According to the company, a major factor was reduced activity in Army-related programs. In simple terms, demand from key government contracts slowed down. And that raises a serious question. If AI demand in defense is growing, why isn't BigBear.ai benefiting from it? Now compare this to a company like Palantir. Both operate in similar spaces. Both focus on data and AI for government and enterprise use. But while BigBear.ai is struggling with declining revenue, Palantir continues to show strong growth. That tells us something important. This isn't just about the market, it's about execution. Now let's talk about cash because this is another major concern. BigBear.ai's cash burn has reached its highest level in the past 3 years. In just one quarter, the company used over $21 million in operations. And when you include capital expenditures, free cash flow goes even deeper into negative territory. That's not a good sign, because it means the company is spending heavily without generating enough return. Now, to be fair, it's not all bad. The company did raise a significant amount of capital through stock offerings. So, as of now, their balance sheet actually looks relatively stable. They have over $330 million in current assets, and their current ratio sits around 1.78, which suggests they can meet short-term obligations. Debt isn't a major issue either. So, in terms of survival, they're okay for now. But from an investor perspective, there's still concern, because that stability came at a cost dilution, and shareholders definitely felt that. Now let's move to growth strategy. Since organic growth has been weak, BigBear.ai is turning to acquisitions. Recently, they acquired 2 companies, AskSage and CargoSeer. These businesses are aligned with their core focus areas, national security and logistics. And according to management, these acquisitions are supposed to drive future growth. Looking ahead, the company expects revenue between $135 million and $165 million for 2026. At the midpoint, that's about 17% growth. Sounds decent, right? But here's the catch. This growth is largely dependent on those acquisitions, which means without them, organic growth might actually be quite low. And that's a concern, because sustainable companies usually grow from within, not just by buying growth externally. And then comes the valuation. This is where things get really hard to justify. BigBear.ai is trading at a massive premium compared to the broader IT sector, around 278% higher on a forward price to sales basis. That's extremely high, especially for a company with declining revenue, negative cash flow, and execution challenges. So investors are essentially paying a premium for a company that hasn't proven it can deliver. So where does that leave us? On one side, you have a company operating in a high-potential industry. Defense AI is growing. Government demand is strong. Opportunities are everywhere. But on the other side, you have weak financial performance, rising cash burn, reliance on acquisitions, and a valuation that doesn't make sense given the risks. Now, could things change? Absolutely. If BigBear.ai can innovate, improve execution, and successfully expand into enterprise AI markets, then this story could turn around. But as of right now, there are simply too many uncertainties. And that's why, despite all the hype around AI and defense, BigBear.ai, at least for now, looks more like a sell than a buy. If you found this breakdown helpful, make sure to subscribe, because we're going to keep analyzing stocks like this, cutting through the hype, and focusing on what actually matters. I'll see you in the next one. This is not finance advice.